Well, ladies and gentlemen, thanks so much for tuning into The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block, and I'm very excited for today's episode, very much within the scope of what we normally hit on this show. I feel like we've got our special niche in the crypto trading and market making world, but this is a new face to the program. Wesley Pryor joining us today. It's interesting because your firm has been around, I think, for 6 years or so, right? 5 or 6 years?
Since Q1 2018.
Okay. And I feel like most trading firms or market making firms in crypto have like two lives where they've operated for X amount of years and then they finally become a bit more public, or they emerge from the shadows, as it were. Every single one has their own version of this. Can you walk us through the firm's journey, why you started it, and for I'm sure many folks will be unfamiliar about where it necessarily sits in the market, but walk us through that.
Yeah, absolutely. And thanks for having me on the show, Frank. A short history on the company. Back in 2017, I was working for a small hedge fund called Enigma Capital, where I was head of trading. And so I was at the desk when we were taking assets from public to, being public on major exchanges. And that's where I really noticed that there was a lack of, institutional liquidity provision in day one listings. So here on one hand, you've got the most critical and important day in an asset's life cycle. And then on the other hand, there's absolutely a void of liquidity on the open. And so that's where I think what any, reasonable investor would do. I started making, phone calls and emails, trying to find a good market maker that I could introduce our portfolio companies with, so that they could, work together and source inventory and provide liquidity on the listing day. And what I found at the time was, really a lot of people that didn't seem to be taking this seriously. It wasn't like a real profession. There was actually a market maker it was like HitBTC, which was a popular exchange back in those days. Their market maker said in the first email response to me, just inquiring, it said, send X amount of Bitcoin and tokens to this address and we'll take care of the market. And I was like, wow, this is totally crazy, right? Like this is totally nuts. And so I kind of brought my findings back to the other partners in the fund. I said, hey guys, like we've already got the inventory in these assets. We'll have better investment outcomes if we're able to provide two-way liquidity. I think this is an area where we should build something rudimentary ourselves to, be able to help support our portfolio companies and ultimately have better returns at the fund. And they didn't really see, the problem the way that I did. And so I started the company kind of as a way to prove out that thesis and kind of as a hobby. And then it ultimately started picking up organic demand from other founders in the industry that were experiencing a lack of liquidity in their own assets they brought to market. And so that was really the origin and genesis of Acheron.
So the value prop, or at least how Acheron got started in the marketplace, was figuring out how to, I guess, maybe streamline or make more efficient the process of that day one debut, that day one market debut. I guess it's tricky, right? When you think about the market structure of crypto, it's not the same in traditional markets where you have sort of this liquidity event and then trading sort of starts at the same time. Whereas in crypto, right, it's like you're trading on a ledger and then you have these different, and obviously that sort of kicks off through a test net and then you have a mainnet. But then each listing or market debut with an exchange is probably different and it's much more fragmented. It raises an interesting question for a lot of listeners. I feel like they don't know how it works. But when you talk about like a market debut for a token, are we talking about like when that token becomes available to the public or when it starts trading on exchanges? And walk us through the market maker's role in both of those sort of instances.
Something important is that typically the tokens being available to the public, that's, hallmarked by the token generation event, where the tokens are generated, and they're distributed to the public. But that's typically happening simultaneously with that token being made available on centralized and decentralized exchanges. So those two events are tied very closely together in most instances. Um, and we call that their primary listing, or you could also call that their day one listing. You could also think about it as their crypto IPO equivalent.
So typically the token generation event happens at the same time as they are listed on a primary venue. I didn't even know that such a designation existed in crypto. So how does that typically work for the token project? Do they work with you on identifying which exchange will be that primary venue? And then how does that whole process work?
Yeah, so they may work with us to help them decide which exchanges are worth pursuing for the primary listing. Of course, if it's a decentralized exchange, which oftentimes most assets are going out in what we call a tandem listing, where they have, your premier flagship centralized exchange, and then you also have your decentralized exchange. So the asset is made available on both venues simultaneously on the primary listing day. But some projects are already in conversations with exchanges by the time they come to us, and then they need to appoint a market maker whose job is to source inventory from the project and place that on the exchanges so that there's a market for the public to interface with when the order books open. And so they may or may not already have a relationship with the exchange. They may lean on us to help guide them in that process. Either way, our main role is to facilitate getting access to inventory from that digital asset issuer and placing that in a systematic manner on the target exchanges immediately before they open to the public, so that when those order books are exposed to the end users, there's actually a market for them to trade with.
With a traditional exchange debut, you have the market maker. You have, like on New York Stock Exchange, you have a designated market maker who's going to effectively help dampen liquidity. How does the process work in crypto? Is the role very much the same, dampening volatility? And what do you need to do ahead of time to ensure that you have a proper understanding of the amount of demand that there might be in the market for that name? And that you're not sort of caught unprepared, right? If there's not enough interest or too much interest.
Yeah, that's I think a good way to look at what we do is kind of similar to what Citadel would do in, listed assets on, major equity markets, except there's some key differences. So one difference and a major one is that there's no real process for, there's no established playbook for exchanges appointing market makers and then working with, the asset issuer to, source inventory and place it on the market. So these are kind of really left to the market participants to sort out. But the exchanges know that they need a market maker. The project knows that they need a market maker. But and then there's kind of like, they leave it to their investors and their advisors and the exchanges to kind of say, hey, like these are the market makers we've worked with in the past. Let us know which one you're working with, and then we'll list you. So it's a lot looser in terms of an established process. And even now, this process is much more established than it was several years ago, where exchanges would list assets that actually didn't have any market makers. And that's what I experienced when I was at the fund. There was actually no liquidity.
And what did that translate into? Just that day one price? Because my understanding, right, was typically when you get that, and this might have changed. This is another thing we can get into. There's so many directions, but it used to be you'd get the Binance or Coinbase pop, but maybe that's only not for assets in the long tail. I'm not sure, but maybe walk us through like how the lack of market makers in a debut, what that translates into, and maybe what you try to achieve. What's the goal?
Yeah, so you can look at the listings in two ways. So there's your primary listing. That's where the asset is being listed for the first time in its history. right? It's just gone through the token generation event. The public tokens, any investor tokens have been distributed, and then it's listed on exchanges for the first time. That's the primary listing or day one listing. Alternatively, an asset's already gone through the primary listing, it's been trading a few months, and then potentially there's, Binance lists it, Coinbase lists it. That would be a follow-on listing or a secondary listing. And then that's kind of where you're talking about a Binance pop or a Coinbase pop. That's, an already listed trading asset that then gets listed on a larger exchange and, appreciates and goes through volatility as a result of that. But coming back to the differences in market making and digital assets for day one listings, I mentioned one key difference is, not having any real processes and procedures for appointing market makers like you would on the NASDAQ, where they're appointing the designated market maker, right? So that's one key difference. The second would be structurally. And what I mean by that is assets, traditional assets getting listed on NASDAQ, they've been priced out. Like most of them have already been, companies that have been operating for a decade, right? And some shorter, some longer, but they've already gone through several rounds. There's, an investment bank that has priced out the deal, and it's all very orchestrated in what the value is, right?
There's been a road show where you're meeting with, the Fidelities of the world to see, what that interest might be on different platforms.
Right. And long story short, there is when it ultimately is made available to the public through the IPO, you're not really expecting extreme volatility, right? It may trade up a bit, it may trade down a bit, but you're not expecting like massive volatility. Whereas in crypto, the role is much more difficult because structurally, these are not late stage companies going public. The going public in crypto is really the inception of most of these projects, because the token being publicly available and trading is necessary for the underlying token economics to operate effectively. So you are seeing these assets come to market and have extraordinary volatility, again, because they're in the very beginning of their journey, not in the late stage. And that's where market makers play a very, very vital role. And they can either execute that role in a methodical way that is kind of aligning the best interest of the project long term and the community that is getting involved with it, or they can potentially use that, asymmetry to their advantage and create a situation that can be detrimental to the project and the community long term. So there's a lot of different approaches and a lot more ambiguity with crypto IPO equivalents.
Well, it's super interesting. I think a lot of people might think of just market making as, there's market making, then there's this specific category that I guess has always existed to an extent, but has become more formalized, I guess you could say, for lack of a better word, which is this category of token market making. How do you sort of think about the parameters of the metrics around success for that specific category of token market making, and how does it then interplay into these other business categories and segments? Because at the same time, right, I would imagine that you're also facing off as a client to the exchanges as well. You're investing in some of these tokens as well, and also serving as this token market maker, which really, I guess the closest equivalent would be like a designated market maker in U.S. equities.
Yeah, I think the way to measure success, and this is something that isn't talked about at all, and it really should be. So if you just kind of look at the dynamics, the market maker is charged with sourcing the inventory from the digital asset issuer, and they're charged with placing that inventory on the target exchanges for the primary listing. Structurally, we know that unlike IPOs, these assets are in the earliest phases of their journey, and a lot of them are going to be hyper volatile on the open. And so the market maker needs to be very, very tactical and measured in how much liquidity they're placing in the order books for the initial open. If, for example, they undersupply liquidity, the asset has a lot of demand, again, because it's in a very early favorable stage, then the asset could trade at a very unsustainable price very quickly and then have a corresponding collapse the next day. And what happens in that case is the market maker didn't supply enough liquidity to meet the demand that came into that asset. And therefore, it went through this rapid rise and subsequent, elevator ride down that is candidly very prevalent in a lot of new listings. Like if you look at the charts, you see this pattern happen over and over again. And really that is due to the market makers not adequately supplying inventory on the open. And then that corresponding rise and fall that happens very rapidly is a result. And at the same time, you may see assets that open and trade down. And that means, the market maker wasn't adequately calibrating enough inventory to mitigate that downside pressure that came in on the open for whatever reason. And so this is really where the amount of liquidity that the market makers are providing needs to be calibrated in a very effective way. And the way that we like to measure that is by looking at the performance of that asset from the first day of its listing, so the all-time high price relative to where it trades the next day. And if there's a massive disparity between the all-time high price on the listing day and where it trades 24 hours later, we know that the market maker probably didn't calibrate the amount of liquidity to provide very effectively. And it led to a hyper volatile environment, which again, market makers should be doing their best to mitigate.
How do you mess that up? Like, how is it just like the math's not mathing or not having the right technology? I guess this gets a bit into the there's some proprietary stuff around this that you probably, this is what the secret sauce boils down to, I imagine.
Partially, yes. But I think in general, there's a few approaches. So one approach is being naive. So like I mentioned, there aren't a lot of established processes and procedures for bringing assets to market as a market maker in crypto. And a lot of the exchanges don't really know what they're doing either. So the market maker may not understand that there's a mechanism called pre-market order submission with most major exchanges where the market maker should be placing liquidity in the order book before it's open for the public listing. Therefore, when that market opens, the public has liquidity already there to trade against. And when market makers don't understand how this mechanism works, they're not placing liquidity. And so the asset is hyper volatile on the open, again, because there's no liquidity. And this could be just a market maker being new to the market, being naive, and not understanding how those mechanisms operate on the target exchanges. And now there's also what I would consider a parasitic approach, where the market maker understands how these mechanisms operate intimately, but they purposefully withhold liquidity such that they're creating artificial scarcity in the order book, knowing the asset may trade to an unsustainable price if they're not providing adequate sell-side liquidity to meet the demand from the customers. And then they start selling the asset at inflated prices, ultimately, to their own benefit and to the detriment of the project and the end users who are buying it at those inflated prices. This is like a parasitic approach, kind of leveraging that asymmetry in information and inventory to extract value from the public market participants.
Are there any other ways that sort of this asymmetric nature of this relationship can be taken advantage of?
Yeah, absolutely. Before I touch on that, there's also, I talked about like a naive approach. And again, we're talking about day one listing market dynamics. I talked about a parasitic approach. There's also a symbiotic approach where the market maker is accurately forecasting the expected supply and demand of that asset on day one. And they're adequately providing both sell side and buy side inventory at those forecasted levels. And then all the assets are volatile in crypto for the most part, but that volatility is minimal. And that's where the market maker really got it right. They didn't provide too much liquidity at too low prices. They didn't withhold liquidity and only provided at inflated prices. And the asset kind of goes through orderly price discovery. And that's what I would consider to be a symbiotic approach that comes from one, experience, two, from operating in an ethical manner.
Let's walk through the exchange's role in all this, because that's not something we really digged into yet.
Well, the exchange's role is to make the asset available for trading for the primary listing to all of their users. And going deeper than that, the exchange should ensure that if they're making an asset available to their users, there's going to be adequate liquidity provision by the appointed market makers on the deal from before that asset it opens to the public and throughout the life cycle of that asset being available on that exchange. And this is where the coordination between the exchange, market maker, and digital asset issuer really becomes important. And the exchange should have market makers that they have on their Rolodex, that they have a history with, that they have a good sense of how these market makers operate and understand, their ethics as well and the level of transparency that they provide. The exchanges should also have guidelines in terms of the amount of, the minimum amount of depth that should be systematically provided in that market by their appointed market makers. So these are kind of the major areas where the exchange should be kind of checking the box before they proceed with the listing and then make that asset available.
Do certain exchanges do a better job of this?
Yes. I think in general, the exchanges, they just don't do a good job managing listings in general. And that's particularly true with a lot of the offshore exchanges. So exchanges like Coinbase, they're typically requiring multiple market makers. Again, they're a very, very large exchange. So there's a lot more activity on that platform than other platforms. So they're making sure that there's multiple market makers that are willing to provide liquidity when the asset is made available to their users. I don't think they're doing a very good job kind of enforcing those provisions. So you may see assets on the platform that are still listed that don't have good liquidity. And then that's where a user could come in, they could try to buy that asset and incur a large amount of slippage on a small order. That's obviously not favorable to the end user. And so the exchanges should be making sure that those minimum levels of liquidity are always adhered to. And if not, they should either remove the listing or they should either delist the asset, halt trading in that asset, or work with market makers to work with the market maker and the issuer to remediate the situation.
That's not really being enforced necessarily. Do we even ever have really delistings? Once things are listed, I feel like that's the end of the story. Whereas with, New York Stock Exchange, NASDAQ, there's parameters around delistings that happen.
Well, there are delistings. So you'll see that, Binance conducts delistings. KuCoin, very, very active in conducting delistings, and other exchanges do as well. But I think the exchanges, take an approach, particularly the offshore exchanges. They'll delist an asset because the volume is low. We saw a lot of delistings during the bear market. So 2022, 2023, where exchanges, the offshore exchanges were delisting long tail assets that were trading over, a certain amount of volume that just really wasn't even realistic. And really the thing is that a lot of these, like if you look at micro cap stocks, not all of them are trading millions of dollars per day, right? They're event driven. right? Something happens, there's momentum, it trades, and then it goes quiet. This is normal. The thing is really, is there adequate liquidity in this asset so that if a user wants to trade it, they're not going to incur significant slippage? And the exchanges aren't looking at it like that. They're saying, well, how much volume is this thing trading? I don't care how much liquidity is there. And if it's not turning over, hundreds of thousands of dollars or millions of dollars a day for a long tail asset, they might delist it. And this is also where you see a lot of abuse. So you'll see market manipulators claiming to operate as market makers, selling things like wash trading as a service. And this is totally detrimental to the crypto ecosystem and the end users. It may be good for an offshore exchange because they're getting revenue off of that activity, but it's totally bad for the end user, particularly if there's no liquidity in that asset, the volume is inflated. So they don't look at the liquidity. They just see, hey, it's got a lot of volume. They try to buy it. And then again, they incur significant slippage because they've been misled. And these are things that really, the exchanges know what they're doing, but they're not doing anything. They're not changing their processes at all. They're kind of looking at the short term and not what's good for the long term of their exchange and the ecosystem.
Super fascinating. Well, I guess we'll leave it there. Is there anything you're super excited about looking towards the next 6 months?
So at the beginning of the call, I think you said, the journey of some market makers, they're very much, in the shadows, and then somehow they're kind of, after some years, they're springing up and they're very active in the market. The thing that we're excited about, and, we're not a firm that is very active and public. We don't have any conference booths. We're not putting our logo on, F1 race cars or anything of that nature. But something that we are shouting from the rooftops is that market making is currently perceived as being predatory and opaque. And the root cause for that is the lack of transparency. No one knows what market makers are doing, even though market makers are a very critical component for the digital asset markets. And so what we do at Acheron is we're trying to change that image of market makers by providing any project we work with real-time access to our liquidity KPIs. And we're the only one that, has set the bar to that level, saying that, we're proud of the liquidity that we provide, and we're willing to share that with you in real time. And so that's the message that we really want to convey publicly. And our goal is that if we do this, and we do this, and continue to do this over the coming years, that projects will demand and exchanges will demand that other market makers rise to that level of transparency. And that will lead to a more robust and healthy digital asset ecosystem with less manipulative practice, less value extraction, and just a more sustainable way of moving into a more mature market. So that's really the message that, we're here to share and really excited about.
Awesome. Well, thanks so much for joining the program.
Thanks for having me, Frank.
Yeah, this was awesome. Talk to you soon.